The conference hall in Vancouver was louder than usual that morning. Conversations echoed between glass walls and polished floors. Investors, analysts, and speculators from every corner of the world moved from booth to booth, each one searching for certainty in a world that had become increasingly uncertain. Screens flashed with prices that would have seemed impossible only a few years earlier. Gold above 5,000. Silver flirting with numbers that once sounded like fantasy. Copper breaking records. Everywhere, people spoke in excited tones. But beneath the excitement, there was something else: fear. He sat quietly in a corner, watching it all. He had seen this before. The excitement. The euphoria. The belief that this time was different. Decades earlier, he had stood in similar rooms when markets rose, when fortunes were made, and when fortunes disappeared. And he knew something most of the people around him did not. Parabolic moves never end gently. When the interviewer approached him, the cameras rolling, the questions began with enthusiasm. Gold at 5,000. Silver at 100. Copper surging. The world changing. Was this the beginning of something even bigger? Or the end of a long journey? He smiled slightly, the way someone does when they hear a familiar story being told again. He explained that nobody truly buys the bottom and sells the top. The only person who claims that is either lucky or dishonest. Real investors don't aim for perfection. They aim for survival. They aim to take a large, comfortable portion out of the middle. That is how wealth is built, not through heroics, but through discipline. Around them, the conference buzzed. Young investors spoke about artificial intelligence and energy revolutions. Veterans spoke about cycles and history. Yet the oldest lesson in markets had not changed. When an asset becomes loved, it becomes dangerous. He remembered when silver was ignored. Years earlier, when prices hovered near levels that most people considered boring, no one wanted it. Social media mocked it. Traders dismissed it. Even those who had once believed in it had lost hope. That was when he bought. Not because it was exciting. Not because it was popular. But because it was hated. He explained that hatred creates opportunity. When nobody wants an asset, its price reflects fear rather than reality. But when everyone wants it, the price reflects dreams rather than truth. And dreams rarely last. So when silver surged, when the same people who had mocked it began praising it, he sold. Not everything. Not perfectly. But enough. Because the reason for buying had disappeared. The interviewer pushed further. What if prices kept rising? What if this was only the beginning? He nodded. They might. Markets often move further than anyone expects. But that did not change the principle. The purpose of investing was not to be right forever. It was to survive long enough to keep playing. He then spoke about gold differently. Gold, he said, was not a trade. It was insurance. He had saved in gold for decades. He hoped that one day it would prove unnecessary. Because gold thrives in uncertainty. And a world where gold fails is often a world where stability has returned. That thought unsettled many listeners. Because it suggested something deeper. The rise in gold was not only about profits. It was about fear. Fear of debt. Fear of currency debasement. Fear of political instability. He described how most people misunderstand money. They think in nominal terms. They see interest rates and believe they are earning. But if inflation is higher, they are losing. Quietly. Slowly. Over years. This silent erosion, he said, had been building for decades. And once people realized it, once they truly understood, markets could change dramatically. The interviewer shifted to geopolitics. Wars. Trade tensions. Alliances shifting. New power blocks forming. Did this matter for investors? He paused before answering. Politics, he said, creates noise. Arithmetic creates wealth. The danger is confusing the two. He explained that most political statements are designed for domestic audiences. They distract. They entertain. They move markets briefly. But long-term wealth comes from understanding supply, demand, and capital. He gave an example. Oil. For years, the industry had been starved of investment. Environmental pressure, low prices, and uncertainty had reduced spending. Yet the world still needed energy. Without investment, production would eventually decline. And when it did, the consequences would be dramatic. He believed this slow starvation was more important than headlines. Because physical reality cannot be debated forever. Eventually, shortages appear. The conversation turned toward banks and credit. Rising defaults. High interest rates. Consumers borrowing beyond their means. He spoke bluntly. People prefer to appear rich rather than become rich. And industries often profit from that illusion. He warned that easy credit creates fragility. When conditions change, weakness is exposed. And cycles repeat. The interviewer then asked about mining stocks. With metals so high, were they overvalued? His answer surprised many. Valuations depended on assumptions. If current prices held, many companies were still cheap. But if prices fell, the picture changed quickly. He explained his method. Always calculate multiple scenarios. Base case. Stress case. Optimistic case. Because the future is uncertain. He stressed something else. Investors often focus on narratives. But numbers tell the truth. He described how institutional investors often arrive late. They chase performance. They move after trends are obvious. This creates opportunity for those who act earlier. To illustrate this, he told a story. A shop owner once offered strangers a choice, a silver bar or a chocolate bar. Most chose the chocolate. Not because it was more valuable, but because it was familiar. That, he said, was human nature. He believed that psychology drives markets more than logic. Fear, greed, hope, regret. These emotions create cycles. And those who recognize them can profit. The conversation moved to central banks. Why were they buying gold? Because trust was declining. Not collapsing, but eroding. Countries sought independence from systems they did not control. Yet he also believed the existing order would not disappear overnight. Change would be gradual. Power shifts slowly. The interviewer asked about the future. The next decade. The next opportunity. He resisted giving simple answers. But he mentioned sectors where supply was constrained. Energy. Critical minerals. Infrastructure. He emphasized patience. True opportunities appear when assets are ignored, not celebrated. As the interview neared its end, he offered one final lesson. If you do not take profits, you do not make money. Paper gains are illusions. Real wealth requires action. He said investors must overcome fear of missing out. Because the greatest danger is believing that rising prices will never fall. The conference continued around them. People hurried past, chasing the next opportunity. Screens flashed new highs. Phones rang. Deals were discussed. But his words lingered. Markets rise. Markets fall. Human nature remains the same. And somewhere in that crowded hall, among the excitement and the noise, the oldest rule of investing waited quietly. Buy what is hated. Sell what is loved. Survive long enough to repeat the cycle. Because in the end, the goal is not to be right once. The goal is to endure. And as the cameras turned off, he stood, shook hands, and disappeared into the crowd, leaving behind a room full of investors who would, sooner or later, learn the same lessons again.